Welcome to Echo Trade. I'm Jeff Roth. Today we're here with Eben Burr from Toews Asset Management. Eben is the president at Toews, 15 plus years of investment management experience. The firm's been around for, I think, almost 30 years, 20 plus employees, 7 of those directly on the investment management committee. So a lot of guys, a lot of expertise that's behind the portfolios. And today we are here to talk about the managed risk architect portfolio offered on Echo Trade. So Eben, thanks for being here.
Thanks so much for having me, Jeff. And I'm really excited to be here. And I'm excited about Echo Trade. I think it's a really cool platform that I think is going to bring a lot of interesting portfolios to people that wouldn't have had access to them otherwise. So I think it's very cool.
Well, I appreciate it. And we're so stoked to have you guys on the platform to partner with us and to partner with a firm like Toews with the experience you guys have. But yeah, let's dive into the managed risk architect and see kind of, first off, I kind of want to start a little bit high level, kind of broadly speaking on kind of the broader, scope of the portfolio, the goals of the portfolio, what's the overarching kind of thesis and the strategy that you guys are trying to accomplish?
Sure. The simplest way to think of it is as hedged S&P exposure. So what I mean by that is we're always invested in the S&P or S&P products, and then we use options to hedge away some of the risk. So we're trying to be full exposure to the S&P all of the time. So large cap stocks, a million names that you know most of, and then trying to limit the risk. Because as we know from years like last year, 2020, the financial crisis, .com bust, all of those times, there are always going to be, there always have been, and always will be times when the market just gets completely decimated. Mm-hmm. And use a product in your portfolio, in all of your holdings, that can dampen that volatility, that can limit that downside risk, is a really important portion, a really important part of building wealth long-term. Because if you don't have to dig out of a deep ditch from a bear market, you don't have to make as much on the upside to get back to where you were before. So strategies like Managed Risk Architect are designed to do that. Limit the downside without much, without much impact on the upside. So we're not going to get 100% of the S&P on the way up, but we'll only get about half to 2/3 on the way down. So in a year like last year, when the market was down 25% at the worst of it, this strategy was only down about 12. So really limiting the risk there. And this year it's keeping up well with the market. So it's up in the double digits.
That's great. So I mean, the goal is not to try to in any 3-month or 6-month or 1-year period be outperforming the market drastically and you got 50% returns or anything crazy like that. You're just trying to stick with the S&P 500, investing in household names, but manage the downside risk on a longer term basis. Because I mean, kind of a typical kind of analogy is, you lose 50%, you actually have to gain 100% to get back up to even. So if you mitigate and you limit those losses, then even if you're not, outperforming during the bull market, you're actually outperforming in the long term.
That's right. And I think with every strategy, really, it's important to see it through a full market cycle.
Yeah.
Because theoretically, if you've got a diversified portfolio, there's always going to be something that's underperforming by design, right? That's what diversification is. It's sort of like a bicycle wheel. If you are missing spokes on one side, it's not going to roll very well, right? Mm-hmm. So you want to have things that are outperforming at different times than things that are outperforming when the vast majority of investments are underperforming. And that's really key to what we do, is that we're designed really to produce outperformance by limiting loss. And that brings less emotional volatility to the ownership of a portfolio, because as the study of behavioral finance has sort of come into its own in the last 10 years, most of the bad decisions we make as investors are because we're scared, or we're trying to get away from something or get into something because we're excited about it. Usually it's a result of fear, right? Trying to get out of something because we're afraid of losing too much, or get into something that maybe isn't a great idea because we're afraid of missing out. Ultimately, it's a different form of fear.
Yeah, so because they say it's fear and greed, but really it's fear on both sides.
It's fear and fear. It's just different kinds of fear.
Yeah. Exactly. I mean, you talk about that. I mean, so kind of the next topic I want to talk about, and then one of the most important is what you're addressing in terms of risk. So how would you guys quantify the risk? Obviously, you're trying to. The whole point of the portfolio is to mitigate that long-term risk. But how would you define the level of risk? Low, medium, high in the portfolio, and then we talked a little bit about it, but what specifically are you doing within the portfolio to manage and mitigate that risk long-term?
So if you were to sort of put it into a category, and in this industry, we love categories, right? This would go into a moderate, sort of just right in the middle category, but really it's got more upside than a moderate and it's got less downside than a moderate. So if you average them out, yeah, it's moderate, but really it's got higher upside and lower drawdown. So that, as often in this industry, the category doesn't quite fit, but it's what we've got, right? And the way we limit that downside is by using options. So without getting too deep into options, because they're pretty confusing, we're buying a 2-year put. So it's over a length of 2 years. When the market goes down, this instrument makes money. It rises in value. But we don't just hold it for 2 years because the market changes over that time. So we manage it dynamically. So if the market moves up, we can move that put up, which in a way sort of raises the floor of how far the market can fall before this put starts to make money. Conversely, if the market starts to fall, we can monetize it. So we can make money off of that put and then reset it. And then as well, we have a portion of the portfolio that can get all the way out of the markets. So it's designed to exit entirely to avoid losses.
So would that be purely in a cash position or in any other instruments?
Yeah, cash instruments. Exactly.
Gotcha.
And one of the things that, there have been a lot of studies that look at 20-year time periods and saying, well, if you miss the top 20 days, then your performance is this. And if you missed the worst 20 days, your performance is this. But it's never been a long enough time frame. And I read a study recently that looked at 40 years of performance. And over the 40 years, the S&P, which is what we're looking to mimic when we're invested, earned about 11% annually. And if you missed the top 40 days, in those 40 years, just 40 days and 40 years, that return went down to 5%. If you missed the worst 40 days in those 40 years, the return goes up to 18%. Significant, right? But of course, no one can make those calls perfectly. However, if you missed the top 40 days and the worst 40 days, so basically just compressed it a little bit, the return came out at 12%. So you actually outperformed slightly, but the emotional ride that you took was much less. So you didn't have the roller coaster experience of, elation, which actually is more associated with gambling than investing, right? Like you never want to feel exuberance when you're investing. That's more on a speculative side. For what we're doing, we're looking at the long term. Traders, yes, they experience exuberance and also devastation. So we don't want to get anywhere near devastation. And that feeling of exuberance where like you've won at gambling, also an emotion that one tends to want to avoid as a long-term investor, because it can set up expectations for a hunger for that feeling again. And then one is likely to take on more risk than they can actually handle because they've experienced that, amazing return that just made them feel like the smartest person in the world.
Well, they go seeking that.
They go looking for it. And you know what? Lightning usually doesn't strike twice.
Exactly. And that calls out on actual trading statistics, and across asset classes, but even in equities, which is the better performing, it's upwards of 90% failure rate. And then if you get into futures and forex, which we've operated in, you're getting into 95, 98% failure rate on any kind of actual day trading performance metrics. So, but it goes to what you're talking about in terms of mitigating risk when you talk about getting rid of the top 40 and the bottom 40 days, where you're actually outperforming because of the importance of managing that risk, but also you're eliminating those negative emotions of fear that you could be making poor decisions on your own because you're going to be afraid you're going to pull out or go back in at the wrong times. by kind of eliminating those areas. So no, it's interesting, kind of strategy that you're going with. So talk a little bit about what you're investing. You talk about you kind of use options as a strategy as well, but this is primarily an ETF based portfolio, and then so options are accessed within those ETFs, if I'm correct, right?
That's right. Yeah, we're doing the options trading within the ETF. That is a significant portion of this portfolio. So you won't get complicated statements about what we're doing there. It'll just show exposure to the ETF, that where we do most of that trading. And the options that we're using there are very standard instruments that are some of the most widely used around the globe. So there's nothing exotic in there. We're just seeking S&P exposure. So those 500 companies that, as I said, we know, well, we at least know the top 20 of them, right? We may not know the 499th, but your Apples and Microsofts of the world, plus just standard old solid companies, large companies, large cap, right?
Gotcha.
And we're not trying to cherry pick the exact best companies on the planet at the moment. That's a different skill set and also involves higher risk generally, because we can look at the risk profile of the S&P over time and make judgments based on that. That would kind of go out the window if you're looking at individual stocks. For instance, looking at Tesla, right? That's a super popular one, where it had a meteoric rise and then just a catastrophic destruction last year. So, we're not looking for that kind of just volatility in the things we use. And of course, there are things in the S&P that will have that kind of volatility, but because you're talking about 500 stocks, the impact is muted of one particular company.
So within the ETF itself, then how many names are you guys trading at any given or holding at any given moment?
So we are exposed to one primary ETF of the S&P as a really inexpensive way to hold that strategy. We're also using some what are called futures contracts, where we're basically getting exposure to the S&P, but using a different instrument that allows us to do some more trading there in terms of having cash on hand and also investing in some fixed income products to provide a little bit of income and stability again there.
Got it. And so are you concerned with anything outside of performance and any types of, there's talks about ESG, any kind of social or environmental impact? Is there any concerns on that within the portfolio, or are you purely concerned about performance and mitigating risk?
We're really, every strategy has a primary and a secondary focus, and some even have a tertiary. And our primary focus, I would say, is market participation, with primary point one being risk management. It's even hard to call it a secondary focus. They're really sort of balanced foci, I guess is the right word there, where we're balancing performance and risk all of the time, because anyone can go out and buy an S&P ETF or just straight exposure to the market with the risk that comes along with that. And we really believe that managing risk is managing your future.
Yeah. Got it. So talk about, and you mentioned a little bit about this, the investment process, what goes into choosing the specific ETFs, what goes into deciding when to go to cash, for instance, or choosing, different ETFs or individual names for the portfolio or for the ETFs. What's the thought process and what's the investment process for that? What's the kind of how you guys searching and screening different options?
With the exposure to the S&P, we're just looking for the least expensive way to do that, to bring costs down for the end user. The other funds that are in there were also chosen for their exposure, but really also primarily for their expense ratio, right? We want them to be inexpensive exposure to small cap, mid cap, NASDAQ, small pieces of those allocations. So we have a little more diversification in terms of US exposure, but with the lowest cost possible.
Got it. And then are there any certain conditions, like market conditions, that this is geared towards? Right now we're in an inflationary period, or we could be coming out of one. Is this kind of geared towards that, or is it nimble in terms of kind of depending on what the market's doing, that you guys are going to be tactically adjusting to that?
Yeah, it's pretty nimble in that, right now it's been a great year for the S&P and for, many stocks in general, which was, I think, a surprise to a lot of people, right? We've been talking about this recession that's coming, and, everybody keeps, well, now it's going to be 6 months from now. And now it's going to be 2025, okay, well.
Or it's happening right now, or it's 6 months from now, or it's the worst. Yeah. So are we going to have a soft landing? Who knows? Yeah.
Right. Mm-hmm. And that's kind of the point. Who knows? You don't know until either it's upon you or it's in the past. So that's really part of the point of a strategy like ours, is you just don't know. Afterwards, you look back and you're like, I knew, but you didn't, right?
Yeah.
They make movies about people who got it right. And it's not very often. So, this strategy is designed for that inability to predict the future.
And then, so obviously this is a different market, within Echo Trade, like you talked about, kind of trying to give access to a different, market of investors, and a different kind of, wrapper, I guess, in the digital wrapper within the platform, for your existing clients. And historically, it's a 30-year, track record on the firm. Have you guys been trading something similarly with your existing accounts? And if so, then what does that kind of longer term performance look like within that portfolio?
Yeah, we have been trading something similar, and the long-term return on that has been about 8.5% annualized, with about between 1/2 and 2/3 of the losses of the greater market. So almost all of the gains, we sort of expect about 10% in the market. That's the number that everybody uses. And we're at about 8.5. So right there with it, practically. And then only about 1/2 to 2/3 of the losses. So really mitigating reduction there. And that's something that we feel great about, and are very, proud and happy to be able to provide to people around, their investment portfolios.
Well, I'd say, that's the goal number one, like you said, kind of 1A of the portfolio, if you can say that. And so it sounds like you're doing a good job of that. But Eben, thanks for being here. Thanks for partnering up with Echo Trade and offering your portfolios to the Echo Trade investor community. And they can get access to the Managed Risk Architect portfolio within Echo Trade. Thanks, Eben.
Thanks so much, Jeff. It's a pleasure.